Hey everybody, it's Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, May 25th, 2024. How you doing? Hope you're doing well. Hope you're going to have a nice long weekend ahead of you, and I appreciate you coming to watch my Weekend Review podcast. In this podcast, what we're going to do, first of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all my trades that I had from last week, both on the daily time frame and the weekly time frame. We're going to talk about when I entered the trade, why I entered the trade, what the strategy was, what the setups were, and most importantly, how I manage the trade going forward, whether it goes my way or goes against me. Last week, a lot of them went against me, and that's just part of trading, but it's a good teaching lesson of how to deal with losing trades because we don't always have winning trades. After that, we're going to talk a little bit about trader psychology. Always the most important skill is the ability to create a plan and then the discipline to follow that plan and see that plan through. It's very important. The keys in trading in the long term to making money are being patient, waiting for confluences, combinations of indicators to line up at major support levels, watch those prices be rejected, and then having a very defined level for a good risk to reward ratio. So if you're wrong, you can be wrong small. If you are right, you have the ability to have an outsized gains. You must position size based upon volatility. The way that I do it, I have an end-of-day stop, I have an emergency stop. There are certain levels when the price gets to that now I'll tighten up my stop. In addition to that, I also take profits, partial profits, when the market moves my way. Um, it has to move a certain amount, but when it moves my way, I will take a portion of that profit off. I call that that's my offensive part of my trading. The defensive part are the stops and when things go against me, but the offensive part is to sell portions of my position into strength. And you'll see on some of the positions that we'll go over in a minute why that was so important, especially if overall the trade turns around on you. You'll see why it was so important that I took profits while I had them. All right, so we'll talk about the trader psychology. After that, I've gone down through my watch list, my master watch list, and I have identified some trades that I am looking for next week, both on the daily and the weekly time frame. They're not where they need to be. If they were, I probably would have already taken the trades. But I like to, on Friday nights, go through my master watch list, look for levels that make sense to me, look for levels that have buying or to other technicals to show me that that's a good level to potentially buy at. And then during the week, wait and see if those prices get there. If they do, then I'll consider taking the trade. If they don't, then I'll just get on to another market. And so we'll go through the ones that I've identified both on the daily and the weekly time frames. And after that, we're going to talk a little bit about the market in general. We'll go to the SPYs, or we'll go to the S&P, and we'll go to the NASDAQ. And there's some things technically that are concerning me a little bit. Doesn't mean that we're going to have a crash or anything like that, but there are some technicals that are showing some bearish signals. So we'll go over that. So I hope that will be helpful for you. And if you do find anything helpful in this podcast, I really would appreciate it if you could hit the thumbs up button. If you find it helpful or valuable, really helps out the channel, lets YouTube know that there's some valuable content here. So if you wouldn't mind doing that, I would certainly appreciate it. So let's get the U.S. legal disclaimer out of the way, and I will be back in about 40 seconds. Thanks so much.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
Okay, here we go, and hopefully my sound's on because I have to apologize. Last week I recorded the entire podcast and I was just in horror when I realized that when I played it back to make sure everything was okay, that I had had the mute button on the whole time. And then to make matters worse, I re-recorded it the next day and uploaded it with sound, but somehow half of the video didn't get uploaded. I still don't understand. But anyway, hopefully we're in good shape today. All right, let's get started with Adobe, ADBE. I did get long Adobe back on the 14th of May here at 468.14. So why did I go ahead and buy this when it got to this level? You see the down blue bar here on the 30th of April, this big down bar. Well, this is called a bullish order block. It doesn't look bullish, right, because it's a big down bar, but it's the largest down bar before I have a change in structure. And the structure came here when we moved above this high here. It changed it from a bearish structure. This changed it to a bullish structure. And you can also see the trend line I have here. We finally broke out of that trend line, also indicating a structure change. But a lot of times after you break a trend line to the upside or after you change market structure to the upside, you kind of have this inevitable pullback. And you can see in this green highlighted area here, anywhere in this green highlighted area is a decent place to buy a pullback after the structure had changed. And you can see it almost came down and tested this, back tested this trend line. The reason that I bought where I did here at 468.18 was because of this big bar after the order block. See the big up bar? If you have a big up bar, very often if the price comes down into that bar, it will find support at halfway. And that's literally why I bought it here, because it did change structure to the upside. It did have a bullish order block. It did come to halfway of this big up bar, and it got very close to back testing the trend line. So I did get long here at 468.18. So as soon as I get long, I immediately have to identify my two stops. First of all, I use a 2 ATR stop. Right now, the ATR value is $20.09. It was a little different back when I bought it because it changes every day. But so the first thing I do is I take 1% of my capital. Let's just say it's $100,000, and I times it by 1%. How much is that? That's $1,000. I take $1,000. I divide it by the value of the 2 ATR. That helps me choose the correct position size based upon the market volatility and the account value that I have. So it's a really good mathematical formula that takes volatility into account. And if you're wrong and you hit your 2 ATR stop, you lose 1% of your capital. That doesn't happen very often, only about 5% of the time. But you have to have a level where you say, I am just plain fat wrong. All right, so always I take my entry, I do my position size, 2 ATRs below my entry is my emergency stop. My end of day stop, it depends on the strategy that you're using, but for this one, just a close below this low. If it closed below this low, it would then change the market structure back to bearish. Okay, now the 1.5 ATR up this green or this orange line up here, this is 1.5 ATRs above my entry. When I enter the trade and it gets to this level, now I start tightening up my stop because it's moved a decent amount and I want to tighten up my stop. And how do I do that? Well, I do that with the rule of if I get to my trailing stop level, then if I have a close below a previous bar's close, I am going to get out of half of my position. Okay, so I marked that up wrong. There we go. There we go. All right. So change market structure. Come down into the bullish bullish order block. I've highlighted the 1.5 ATR here. Now, on the offensive side of the equation, if the price moves the value of 0.45 ATRs. Right now it's $4.52 from the most recent bar's close. I will take off 10% of the remaining shares. So just right here, the current price is $475.43. I would take $475.43, add now $452. That will be my first profit target for Monday or for Tuesday. I'll take the first profit target, add that again. That will be my second profit target. I'll take the second profit target, add it again. That is my third profit target. So I always take the closing price of the day, add the 0.45 to it 3 times, and those are my profit targets for the next day. And you can see it's a good idea that I bought that. All right. So I did buy this. All right. I did buy this here at 468.14. Next day, I hit one of my profit targets because it moved the value of 0.45 ATRs up. Okay, and it also got to my trailing stop level, which all that means now is if I have a close below a previous bar's close, I will get out of half the position. So bought here, actually during the day, because it moved up, I did take profits, and then moved up again here. I took one more profit target. Then we had sideways motion, didn't do anything. On Thursday, you can see it did go up, and so I took another profit target. So I'm taking profits into strength. Again, got to trailing stop level pretty quickly, and then Friday was the first close below the previous bar's low after, after getting to trailing stop level. Sorry, I've had some problems with my charting. And so I did take half of my position off. Jeez. Sorry, everybody. My charts have a mind of their own today. There we go. It's the first close below the previous bar's low after reaching trailing stop level for a gain of about 1.64%. So I still have half of the position available, but you can see it was good that I did take partial profits when I had them. So I have half the position left, up 1.64%. Okay, FXY. FXY is the Japanese yen, and I did get long back here on the May 20th at 59.24. Why did I get long? Well, you can see this bar right here highlighted in green. This is what's called an abandoned baby, a bullish abandoned baby. An abandoned baby happens when you gap down and then very next day gap up immediately. Why is that important? Well, the gap down indicates that overnight there was some bearish sentiment. The gap up, the immediate gap up the very next day indicates that there is bullish sentiment. So you've gone from bearish to bullish very quickly. And these are one of my favorite new approaches that I use because the sudden switch and turn in sentiment from bearish to bullish in a very short amount of time, in my experience, indicates that as time goes on, that price will go higher. Okay, this is a very defining moment. So when this happens, and I got long here on the 20th of May, why I didn't buy right here, it seemed a bit extended. So I waited for it to come down and fill the gap. So I got long here, 59.24 on abandoned babies or island reversals. I use a very simple exit strategy where I place a 2 ATR stop if I'm wrong, and I place a 4 ATR profit target if I'm right. In my experience, these are profitable about 70% of the time, and that's a pretty good proposition. If something is profitable 70% of the time and you make 4 ATRs profit, and it's unprofitable 30% of the time, and you lose only 2 ATRs, well, that's a good mathematical proposition, and that is what, for me, defines the edge in this approach. So you can see down here is my 2 ATR profit, or my 2 ATR stop loss. Up here is my 4 ATR profit target. Good example was here. You gap down, you gapped up, created abandoned baby. I got long right here, 2 ATR stop loss to the downside, 4 ATR profit target to the upside, and you can see just absolutely nailed it. So this is the second attempt at this. Currently, it's underwater, but I'm still in the trade because it hasn't hit my profit target or my stop loss. Down slightly, down 4.2%. All right. So those are the two open trades, Adobe and FXY. FedEx, oof, this has been a tough trade. I took this trade here on the 21st of May. Why? Well, because we rejected the 250-day moving average. This is a key level. It's a key moving average. During the day, we went below the 250, and then we recovered at the end of the day and closed above the 250. Place my profit target or my trailing stop level up here, have my 2 ATR stop, 2 ATRs below. My end of day stop is simply a close below the 250. The next day we went below it again, cover ended the day above, finished the day above. That kept me in the trade. But the next day on Thursday, when we had the big down day, it did close below the 250, and I had to get out for a loss of 1.2%. You know, it's okay to have losses. You're going to have losses all the time, but the key is you have to keep the losses small. And it's nice to have a very defined line in the sand. That 250 is the line in the sand. Stay above it, great. I'm bullish. Closes below it, I'm out. No questions asked. I just get out, and that's it. So had a loss here of 1.12%. McDonald's. Okay. You know, you hear me talking about the emergency stop and that it doesn't happen very often, only 5% of the time. And that is true. But there is 5% of the time that happened, and this did happen to me. But this is a very good example of why taking profits, taking half off when you have a close below a previous bar's low, all the defensive moves that I put into my trading, this one really shows the importance of having those and the value of those. So I did get long McDonald's back here on the 8th of May. Why? Well, we were in a bullish fair value gap here. We broke structure to the upside. When it came back into the fair value gap, that's generally a good time to buy it. I did that here on the 8th. I got long when we had a V1. V1 consists of two bars, bar 1, bar 2. Bar 2 goes under bar 1's low, closes above bar 1's close. So this was a combination of indicators where I had a V1 and we were back in the bounce zone, and that's exactly what I did. So I bought at 268.30. My end of day stop is simply a close under these lows. My emergency stop, 2 ATRs below my entry. Next day didn't do much. Next day had a huge move up where I took off, I can't remember now, 2 or 3 profit targets. Okay, remember how important that is, that I took off 20 or 30%. I think this was 3. I'm pretty sure this was 3. So that would be 30% of my trade right here. Profitable levels, reduce my position size, and ultimately, because of what happened here, that was very important because it mitigated my loss. Okay, then we got to trailing stop level, which means now if I have a close below a previous bar's low, I'm going to get out of half. That happened here on the 14th. We closed below a previous bar's low after reaching trailing stop level. I exited the remaining half of my position for a gain of 0.85%. Okay, not huge, but still a gain, and most importantly, that I reduced my position. Next day we moved up. I took some more profits off, took some more shares off at profitable levels, and then we just came down and down and down. Wednesday, the only thing that kept me in this trade was because we did not close below these lows, and then Thursday when we had the big down bar, we got to my emergency stop. Now, if I would have not taken profits on any of this, this would have been a horrible losing trade, right? I would have lost 1% of my total capital. But that didn't happen because of the offensive moves of taking profits when I have them, have a process in place where I take half off when things aren't going well. So did this end up being a losing trade? Yes, slightly, but very slightly, because of the offensive part and the taking off of here. So that's why I'm such a big fan of taking partial profits when you have them. You lock in those profits, the market can't take those away from you, and most importantly, if the trade turns back around on you, you have fewer shares and mitigate. So this is the first emergency stop I've hit in a long time. The remaining shares down 3.13%, but again, the remaining shares are very low. Okay, Home Depot. Another really good example of why it's important to have a process and take partial profits. I got long Home Depot here on the 1st of May. Why? Well, because price rejected the 200-day moving average on that day. We went below the 200 during the day, closed back above, showing me at the moment there were no more sellers under there. Got long at 331.80. I position size correctly. I placed my emergency stop 2 ATRs below. My end of day stop is simply a close below the 200-day moving average. I placed my 1.5 ATR trailing stop level above, and as always, if it moves the value of 0.45 ATRs the next day, I'll take partial profits. Next day moved up. Don't think there was enough for partial profits on that day. Next day moved up substantially. Did take some profits off. Now I'm in trailing stop mode. Here is the first close below the previous bar's low. After reaching trailing stop level, I sold half of my remaining position for a gain of 2.19%, which is important. And then next day we moved up again, took some partial profits into that strength, and we came down, we tested the 200, held, had a big move up here, took more profits while I had the profits, and then of course over the last 6 or 7 days, Home Depot has just gone straight down, straight down, straight down, straight down. And then here on the 22nd of May, it finally did close below the 200 for a loss of 0.34%. But all in all, this trade was obviously profitable because of the partial profits that I took, taking half of my position off when we finally closed below a previous bar's low, again, taking profits into strength, which was very important. So yes, the remaining shares had a loss of 0.34%, but overall, because of the process that I have and the rules that I have, this did end up being a profitable trade. Okay, so just a real quick recap on all the dailies. Adobe open up 1.64%. FXY open down 0.42%. FedEx had to close that one with a loss of 1.2%. McDonald's loss of 3.43%. And Home Depot, the remaining shares, a loss of 0.34%. So yeah, pretty tough week, and they definitely happened. But the key is realizing that they're going to happen and having faith in your system, having faith in your process, and just getting on with the next week. That's it. Okay, on the weeklies, I was short IBB, which is the iShares NASDAQ Biotechnology. Why did I get short here? Well, you see the highlighted blue bar. This is an up bar here. Why is this bearish? Well, it's bearish because you had a big up bar, and then you had a break in structure. You broke below this swing low here. This changes you into a bearish structure. And when you have a downtrend, you want to short rallies, okay? So anywhere from the top of this bearish order block to the bottom of this bearish order block is highlighted here in the red bars. Anywhere when we come back into this red zone here, this is a legitimate shortable area. I got short the week before because during the week on these weekly charts, we went above the 200 week moving average and closed below it. It showed that there were no more buyers up here. So the confluence is we're in a bearish zone anyway, and then we had bearish price action by the market rejecting, or IBB rejecting, this 200-day moving average. So that sets up for a pretty good short position. So I did get short at 136.69. Okay, I'm going to have my emergency stop 2 ATRs above, clearly, as I always do, whether I'm long or short. And my end of week stop is simply going to just be a close above this 200. So if I'm wrong, most likely I'll be wrong fairly small. But if I'm right and we head back down, I have the potential for a large trade, and that's the key in trading, right? Is setting yourself up good, being patient, waiting for good setups, and then structuring your trades so that if you're right, you have the potential to be right big, and if you're wrong, you have the potential to be wrong small. The end of week stop on this one is simply a close above the 200-week moving average. During the week, we did get above it, but now we are below it, and so this particular trade is currently up 0.72%. So it's good to have some green there. And I know these sounds like a lot of rules that I have, and I do actually have a lot of rules. I've been trading for over 28 years now, but every rule that I have in my trading process, there's really a reason for it. And if you're wanting to understand trading, if you want to get more serious about trading, you want to really learn how to trade all the strategies step by step like I do. I do offer private one-on-one lessons in the evening time via Skype. I teach a one-on-one course that's 15 hours, 5 sessions, and 3 hours per session. So it's a total of 15 hours. It's a really great course. I've taught people from all over the world, from beginners all the way up to the hedge fund level and everywhere in between. And when you're done with this course, you will know how to trade exactly how I trade. You'll know it like the back of your hand, and you'll have a skill for life. So if you're interested, just please send me an email, and we can talk and talk about the class, and you can ask all the questions you want about the format and everything like that. It does cost $1,750, but I know it sounds like a lot of money, but it is a really good investment in learning a skill, and I'll teach you everything that I know. So if you're interested, just contact me. So on the weeklies then, just one particular trade, currently up 0.72%. So yeah, not the best week I've had in a while, but that's okay because I've had some really good weeks in the recent past. But that's part of trading. You just are not going to win. What's important is not whether you're making money or losing money, but what's important is that you have a good process that takes into consideration good trading principles and realizing you're not going to win every week, but that you're following your process. That's the higher good. That's the more important thing. Don't worry about profit and loss. Just focus on the process. So, excuse me. Let's talk a little bit about trader psychology before we get on to next week's picks. This is from Trading Composure. Trading Composure, great, great, great channel. Follow him at Trading Composure over on Twitter. He always posts so many good things about trading psychology, and I highly recommend reading what he puts out. Let's see what he has to say. Maintain balance in your trading mindset. Don't let winning trades inflate your ego, nor losing trades crush your spirit. Stay grounded and focused on the process. What I was just talking about, right? Focusing on the process, not the P&L. Don't ever let winning trades go to your head or losing trades to your heart. And it's so true. I've been trading for so long that sometimes when you're trading well, you feel like you're never, ever going to have another losing trade again. You just feel like, oh my gosh, I'm the master of the world. I know how to do this. This is super, super easy. And then there's other times when you feel like you're never going to be able to make another penny again. I am never going to have another winning trade. Everything I do goes against me. I think the market's against me. They must have a camera and they're seeing what I have. Okay, if I do this, the market's immediately going to do that. Hey, I totally understand that. I have totally been there before. Last week felt like that. Honestly, right? No matter almost what I did on my swings, it went against me. But it happens to everyone. It happens to every trader. Anyone that's traded for any amount of time, I'm sure those words have come out of their mouth like, I think they're watching me. They're doing whatever I do, they put out the bulletin, do the opposite. So sometimes we never feel like we're going to lose again. Sometimes we're never going to feel like we're going to win again. I assure you, both of those things are going to happen. But what Trading Composure here is saying is very important. When you're winning and winning and winning, don't let it inflate your ego. You just are in sync with the market, which is fortunate. You're in sync with what the market's doing, so you're making money. But don't don't let it make you think you're the best trader in the world and you're infallible, and that you loosen up on your standards, or your position size too high, or you let things go too far this way or the other. Just get your process and follow it. When things are going great, great. But just realize they're not always going to be that way. And when it's going against you and losing trades, don't let it crush your spirit, because it just means that you're out of phase with the market at that time. And, don't double up your positions. Try to get your money back. Just stay nice, cool, consistent with your process like a robot. It's really my best advice. So one more time, maintain balance in your trading mindset. Don't let winning trades inflate your ego, nor losing trades crush your spirit. Stay grounded and focus on the process, regardless of your winning or losing. That's the important thing. Not the profit and loss, but focusing on the process and letting your process work out mathematically over time. All right. All right, well, let's get on to the potential setups for next week. Like I said, I went through these Friday night, went down through my entire watch list, and I'm looking for setups that are not where they need to be yet, but if they do get there, they would offer a good risk to reward entry. Doesn't mean they're going to win, but really the only thing that you can hope for is that you're patient, wait for something to get into an area that, hey, there's some support here, there's some price action that indicated that maybe we're not going down anymore, position sizing correctly, and putting the trade on and knowing what you're going to do regardless of what the market's going to do. Okay, so this is BITO. This is Bitcoin. All right, I have this green zone up here. Well, this would be, if price gets to this area, that would be an area where I would be looking for a short. Okay, let's start off. First of all, why? Well, here we broke market structure to the downside, and we have a fair value gap between the high of this bar and the low of this bar. So anywhere in between here in this highlighted red area would be a bearish fair value gap. You can see we broke structure here on the 22nd. As soon as we got to that area, market didn't like it. I mean, almost to the penny when it got to that area, came back down. Here is another bullish order block, or not order block, island reversal, and that nailed it. I didn't take the trade. I was waiting for it to come down to here. Look how close I got, and I missed it. But I set the levels. If they get there, I take it. If they don't, I just let them go. And yeah, definitely worked as advertised. So I'm looking to short BITO if and only if we get somewhere between 29.23 and 30.47, somewhere in this area. If I wanted to just be, if I wanted to make it easy, I would just go, okay, I'm going to short here at 2023. But I like to see what the market does, maybe get a V1, V2 to the downside. The ideal place would be if it came to the top of this fair value gap at about 30.47. Why? Well, then I have the best risk to reward ratio, because my stop would be a close over the top of this bar here. So I wish I could be more specific, but I can't, because I just don't know what it's going to do. I just have to see how it reacts in this area before I take on any kind of short. But this is the area that I'm looking for. And by the way, I say this each week, but here's 8 symbols next week. So if all these triggered hypothetically on the same day, would I take all 8? No, I would just narrow it down to the very best one. And how would I do that? Well, I would look which one has the most combinations of indicators, which one has the best risk to reward ratio, which one was weakest or strongest relative to the market, which one looks best on multiple time frames, because I don't just look at one time frame. I want to look at the higher time frame to see if it's supporting what I'm doing on the lower time frame. So this is really the nuanced part of trading, is how to narrow down if you have multiple trades that happen at the same time. And it's it's a real skill, and it's very important. It's like grading. Okay, this one gets an A, this one gets a B, this one gets a D. Which one am I going to take? I'm going to take the A. right? Or the A plus. Even if there's A's, if there's an A plus, I'll take the A plus. So, and again, this is what I teach in my one-on-one course. So Bitcoin looking for a short somewhere between 30.47 and 29.23 next week, and I'll just have to wait and see what that price action looks like. INDA. Well, INDA is the iShares India. It's basically the Indian stock market. And look at this crazy market. My gosh. What I want to point out here are the abandoned babies and the island reversals. Look, here is a bullish setup, a bullish island reversal. Island reversal. Was it? Did it nail it? It sure did. Here is a bearish island reversal. Did it nail it? It sure did. Here is a bearish abandoned baby. Did it nail it? It certainly did. Here is a bullish island reversal. Did it nail it? It certainly did. Here's one over here, bearish. So, I mean, this particular market, abandoned babies, island reversals, really tend to nail this. And by the way, if you'd like to learn more about abandoned babies, island reversals, go to my YouTube channel, look in the lessons playlist, and you'll see that I have a video lesson there. So what am I waiting for up here? Well, so far we don't have an abandoned baby. So far we don't have an island reversal, but it's starting to look to me like we could. See how we gapped up from Thursday to Friday? If on Tuesday we gap down, we would have a bearish abandoned baby. And that's really what I'm looking for. We're very overbought. I'm just looking for a bearish island reversal or abandoned baby. And if we do have one, very likely I'll take the trade. So, you know, if we gap down here on Tuesday, this would indicate more likely than not that this is a top. Of course, it doesn't have to be. You don't, about 70% of the time, in my experience, it gets it correctly. But even if we have a gap down on Tuesday here, this would create a bearish abandoned baby here, and I would definitely take that trade. You know, as long as it looked good. So that's what I'm considering here. There is no trade yet. I'm just looking for a bearish abandoned baby or a bearish island reversal. And like I said, if you'd like to learn more, just go to my YouTube channel, watch the lesson on abandoned babies and island reversals. So that's what I'm looking for in INDA. Intel. Okay, well, Intel, what caught my eye about Intel here is currently we're very close to well, actually we already did, have a double bottom here with a bullish divergence. You can see the red bars, these are the MACD bars. These show the momentum of the move down. When they're red and getting deeper, this means the momentum is getting higher and higher and stronger to the downside. Then we rallied here into some green. Now if we come back down and test this low here, everyone, you can see we almost did it on Thursday. But next week, if we come down to these lows, then we'll have red MACD bars with a rally to green, and then we'll be back at the low. And if we're back at the low but have no red or have less red here than we do over here, that all that means is the selling is starting to run out. The selling momentum is running out. We're running out of sellers. The momentum is diminishing, and the implication of that is that we'll probably be going up. So first of all, I needed to come down here, test these levels to give me a double bottom bullish divergence. Once that happens, it doesn't mean I immediately go ahead and buy. All that means is now the double bottom bullish divergence is complete, and then I need to look for a trigger. A trigger could be an under 30 over 30. It could be a higher low V1 or V2 in the value zone. It could be a bullish abandoned baby or a bullish island reversal. So the stage to me is looking set that we're forming a bottom and that we're running out of selling. But now to get long, I just need a trigger. Like I said, under 30, over 30, bullish abandoned baby, bullish island reversal, higher low V1, V2. These would all qualify to get long. Johnson & Johnson. Wow. Okay, highlighted highlighted blue bar here, that's the biggest down move before a structure change to the upside. And we did have a structure change to the upside over here when we took out this swing high. So this would be the buyable area for me for Johnson & Johnson. It would be legitimate to get long just right here when it got to 145.80. I'd like to have it a little bit deeper in here. Why? Because it would just give me a better risk to reward ratio, because my end of day stop would simply be if we close below this bullish order block, then everything changes again. But right now, we still are in a bullish market structure, and when you're in a bullish market structure, it's a good idea to buy the dip, as long as you have your stop set and all that kind of stuff, right? Emergency stop and bar stop. So I would consider getting long J&J if we came down, bounced off the top of that bullish order block and went up. I would consider getting long there. If we came down here into halfway, that would also be interesting. So it's tough with these order blocks to really say exactly how I'm going to do it. I'm just telling you, this is the buy zone area. You can make it complicated or let the least complicated as you want to, but I'll just have to see. But I do kind of like this trade. I really do. The last few days we've really sold off, but somewhere in this area between 145.80 and about 143.26, right in this area. You know, to give you an example, if we came down here into the order block and then had a V1 to the upside, that would be an interesting entry as well. But you know, obviously, the lower you can get it in here, the better your risk to reward ratio. But I do like this setup. Just going to see if it either bounces at the top of that order block or comes down into the order block. Who knows? It may not even get there. It may just take off from here, and I will have missed it. But that's the area, that's the zone that I'm looking for on Johnson & Johnson. Southwest, very similar. Here is the top of the order block back here on May 1st. Biggest down bar move before structure change. And so this is the exact same thing as Johnson & Johnson, somewhere here between about 26.19 and 25.54 in this green box here, in the order block. Somewhere in this area here would be the buy area for me as well. And I can already tell from a double bottom bullish divergence, we obviously don't have a double bottom yet, but I can just tell that we have the deep red bars here. We're getting close to having that double bottom. Even if we do have the double bottom, we're not going to have the red that we had over here. So pretty good. We'd have a double bottom bullish divergence and inside of a bullish order block. Nike, same thing. Here we go. Here is the bullish order block. Biggest down bar before structure change. This is a good example here of, look, we came right to the top of that bullish order block and bounced. So that's an opportunity to get long, and that did work well. So I'm waiting for Nike to come down between about 90.12 and 88.70, kind of some range there. But somewhere in this area here is where I would be looking for a buy area. And again, I just can't say exactly what it's going to look like when it happens. But, you know, if I have a V1 or a V2 inside of this bullish order block, you know, that would definitely be something for me to get long this. Or coming down and rejecting the top of that bullish order block would also be something interesting as well. Virgin Galactic, SPCE, again, exactly the same thing here. Bullish order block, change structure to the upside. You can see on Friday we almost got there. So if we do get there, bounce off, I will consider or get deeper into the bullish order block with the V1 or something like that. That would also be potential for me to get long. And then UUP is the dollar. Same thing, but this is the opposite way. Here we have the highest up bar before structure change. So UUP would be a potential short anywhere between 28.86 and 28.98. And again, we could come up here, touch that, and then just reject it, go down. That could be a potential short, or we get higher into the bearish order block and have a V1 or a V2. That would be potential signal to get short. And then my stop would just be a close above this high here at 28.99. And because if we did that, then we're changing structure to the upside. All right, so those are the dailies. Let's head over to the weeklies and see what we have. Okay, Apple. Well, Apple certainly looks like it's doing well, but we are coming into that shortable area. Here's the order block, highest up bar before structure change. And you can see after the structure change, when we got back up in there, it failed, did fail strongly. Now we've had this big move up. I'm looking, this one's quite easy. I mean, actually, this could have been a legitimate short on Friday because it did reject the bottom of the bearish order block right here. See how it got there, closed below, and that might be it. It may head down from here, but what I'm looking for is this red line here, 194.40. Why this area? Well, one, it's in the bearish order block, and two, it's halfway of this down bar from the top to the bottom. The down bar, whenever you have a big down bar and you get back to halfway, a lot of times you'll fail. You can see it's exactly what happened right here, right on the 26th of January. We got to the halfway of this bar, rejected it, failed dramatically. So that's what I'm looking for. So if we get to 194.40, if we get to this level and then reject it, that would be a potential short for me on the weekly here in the bearish order block and the rejection of the halfway. FedEx. All right, well, we've talked about FedEx. I had that trade that I had to get out of, but on the weekly, look, we have another bullish order block. Biggest down bar before structure change. So here we go, somewhere between 243.34 and 232.84, somewhere in this green highlighted area, somewhere in the bullish order block would be the location that I would be looking for a bounce. The all-time best area here would be this 200-week moving average, and who knows, maybe it gets there, and that gives a very easy trade to structure your trade off of. You know, I'm in above the 200, out below the 200, but you know, ultimately the very best place I could buy this is 232.89 because it's the bottom of the order block and it's the 200. A lot of confluences there, but who knows? I don't know what's going to get there, but I will consider taking FedEx next week if it rejects the top of this order block here at 243.10. This would be another area right here. Why? Because it's halfway of this up bar. Up bars halfway, up bars halfway tend to have some support there, just like when I bought Adobe, exact same kind of thinking. So 238.70 would actually be a really good area in the bullish order block, halfway of this up bar. So anyway, I wish I could be more specific, but I'm just going to have to wait and see. But basically, somewhere between the high of this green box at 243.10 and 238.70 is the area that I'm looking to buy. And then last but not least is Meta. Okay, Meta on the weekly. What am I looking for here? Well, it must be order block day because about everything I've talked about is order block. You know, depending on the market, you know, sometimes I'm looking at order blocks. Sometimes I'm looking at 200-day moving averages. Sometimes I'm looking at fair value gaps. Sometimes I'm looking at crossovers. So you have to have a lot of tools in your tool belt to be able to deal with the market that you have. Some people just have one trading style, and it's great when the market is in that mode, but it may be in a different mode. I mean, the market always changes, going up, it's going down, right? So we need different trading approaches and different strategies. But just right now, based upon the market, there are a lot of bearish order blocks, there's a lot of bullish order blocks, and that's why most of the day today we've talked about order blocks. So again, bearish order block on Meta, we had the big up move followed by the structure change to the downside. Well, anywhere between 531.55 and 481.22. This is the shortable area. For me, the real area, or my ideal area, would be, see the big down bar here, halfway about 495. A rejection of this right here for me would be a very good short location. All right, so I hope that helps. And if it did help, and you, like I said, if you found something of value, I really would appreciate it if you could hit the thumbs up button. It does really help the channel and helps let YouTube know that there's some valuable content here. All right, as I said at the beginning of the podcast, let's look at the markets in general and try to get an idea here. So these are the QQQs. This is the NASDAQ on the weekly. And the thing that concerns me about this, everyone, is let's look at these highs here. You see the corresponding green MACD bars to the upside. This means there was a lot of buying strength and momentum. Well, then we pulled back. Obviously, momentum went red. But look at this. Now we are higher than over here. But does MACD confirm that this higher high, or this higher move here, does it confirm with a lot of green MACD? No, it doesn't. This is called the double top with a bearish divergence. And even worse than that, it's a double top with a bearish divergence and a missing right shoulder. There is no green. All this means objectively is that, yes, this move up here, very, very strong, but from a MACD standpoint, it's not supporting the thesis of that from a MACD point that it's strong. It's running out of momentum. This is bearish. Having these divergences is bearish. High with high green. Now we're higher with no green. That's bearish. Let's also look at the RSI. Look here. Look how high the RSI here is at this top. Now we're even higher. Obviously, we're higher here than we were here. Look at the RSI. We are lower. That's an RSI divergence. Let's look at ATRs. Here's the ATR channel. At the high here, we were at like 3.5, 3 5/8 on the ATR. Now we're much higher. We're not even to the second ATR. So this is the trifecta of divergences. MACD divergence, RSI divergence, ATR divergence. Big picture, these are bearish signals. Now, it doesn't mean that you just get in here and short the heck out of this, because divergences really don't matter until they do. Yes, there are all sorts of bearish divergences here. And if I look out in time, I would think more likely than not in the future, we're going to be lower than this. I don't know. I could be wrong. But what is really important with divergences is that usually if you get a trigger, something political, something economic, something geopolitical, that when you have these bearish divergences and something happens, they fall hard. So please be careful. And if we look at the SPY, well, we have the exact same thing. Higher high, bearish MACD divergence. RSI here, high. We're higher here, much, much lower. Here, 4.25 ATRs. Now we're only at 2 ATRs. So it's very telling to me that this move up here has been on lower and lower momentum, which kind of indicates to me that we're either nearing a top or have the potential for a down move. I could be wrong, 100%. I could be wrong, because divergences really don't matter. But the one thing I do know is when you have these divergences, bearish divergence, and something happens, that's usually when you go down. But we'll see. I definitely, I don't know for sure, but I'm just showing you what I see on the technicals. So, hey, listen, if you like online courses, I have a great online course that's available at udemy.com. It's called the Deep Dip Buy Stock Trading Approach. It's very affordable. It's 9.5 hours of video, 26 videos total, 15 study guides. I teach you step by step how to trade the deep dip buy signal using the 200, the 250, the 300 SMA, the 30 RSI. I've sold so many of these around the world. I think I have like 4.8 or 4.9 stars on that. I talked about my private one-on-one lessons. Obviously, the private one-on-one lessons are great because I teach you all my trading strategies. But, if you're not financially in a place to do that, The Udemy course is very, very affordable. It's somewhere between 12 and 40 bucks, depending on the days. But you get a lot of content there. You get a lot of good instruction. And so the link's in the description. If you're in the financial space to be able to take the one-on-ones, I promise you, you're going to love it. You're going to love it. You're going to learn lots and lots of things. You're going to come away from that and think, wow, I learned a lot. So again, I appreciate you being here, everyone. If you like the podcast, I would appreciate if you could hit the thumbs up button. I hope you have a very good rest of your long weekend. Please be careful with your trading, and God willing, if God willing, I will see you next weekend, and we'll see what happens with this market. But thanks for watching it. If you made it all the way through, really appreciate that, and I hope you learned something and it was helpful. All right, everyone, take care. I'll talk to you soon. Bye-bye.
U.S. Government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.